infrastructure a couple years ago, people really didn't know what it was. There just wasn't a way to invest.
What do you like in the space and what stinks? What do you hate?
And sometimes we have these conversations, people call the asset class boring. I like to call it predictable.
How does infrastructure behave differently from traditional assets during periods of inflation or volatility or economic uncertainty?
I think when we as KKR think about infrastructure, you kind of got to take a big step back.
Hi there. It's Greg Poole and Pat Dwyer from Aligned Wealth in Miami. Today, we're very pleased to have James Cunningham with us to talk about infrastructure. James is the CIO of KKR's Evergreen Infrastructure Vehicle. Welcome. Good to see you. Perhaps you could start out giving us a little bit of your background.
Perfect. Well, appreciate you all having me. It's always fun to join and talk about infrastructure. So, quick background on myself. As you mentioned, I'm the CIO of our Evergreen product. I've spent broadly my career in the energy and infrastructure space, the last over 8 years with KKR on our infrastructure team, both leading investments, but then also thinking about capital allocation in the Evergreen product. Prior to that, was an investor, an investment banker, and worked in some operational consulting in the energy and infrastructure space. So think utilities, pipelines, things that I think we all consider infrastructure now has really been where I spent the vast majority of my career. Good to join you guys.
Yeah, infrastructure has gone from being like something that no one really talked about to being like one of the most interesting kind of diversifying asset classes out there. Kind of would you describe to our clients, how does infrastructure behave differently from traditional assets, during periods of inflation or volatility or economic uncertainty?
Yeah, absolutely. So I think when we as KKR think about infrastructure, you kind of got to take a big step back and think about just philosophically how we're defining the asset class. And to your point, infrastructure a couple years ago, people really didn't know what it was, certainly didn't know what it would do for their portfolio. And frankly, there were not access points for private infrastructure. There just wasn't a way to invest other than, a couple big public equity angles. And so we've spent a lot of time educating folks on what is the definition of infrastructure, what's our definition of infrastructure, and starting there, and then we can talk about how it behaves differently. Our definition of infrastructure, we try to really simplify it into four key characteristics. The acronym for that is HELP. The H is hard assets. So these are collateral backed cash flows. These businesses are not services businesses. They are hard to replicate physical assets in the ground. The E is that they provide essential services. That probably doesn't come as a surprise when you think about electricity, power generation, distribution, airports and ports, natural gas pipelines and LNG export facilities, cell tower networks, data centers. These are all infrastructure. These are absolutely essential. As GDP moves up and down, we still utilize these at a fairly consistent clip through market environments. Then the L is we like to have long-term visibility to cash flow. And that long-term visibility to cash flow, in the case of some assets, they're regulated. And so you almost have like this permanent cash flow as you invest in the assets. Others, we have long duration contracts with commercial customers. We may have 5 years, 10 years, in some instances, greater than 30 years of commercial contracts. We have that visibility to where the cash is going to come from. We're not looking month by month or quarter by quarter trying to figure out where the cash is. And then the P is a premium market position. So, these are collateral backed cash flows. They require a lot of capital, and that capital creates a moat around these businesses. And so when we say premium market position, they're just hard to replicate because in many instances, you got to get those commercial agreements. You got to spend a lot of capital. Sometimes there's permitting issues around it. So you end up in a premium position where you're able to own and continue to hold these long-term contracts. So that's what the key characteristics of the asset. That definitely doesn't answer your question, but if we think about the question specifically about how infrastructure behaves differently during times of volatility, you kind of look at those key characteristics and you can start to see why infrastructure as an asset class is more front of mind. It's providing stable returns through cycles. In the case of inflationary periods, we're obviously coming off of that now. We had a big test in the asset class from 22 to 23. These contracts oftentimes provide direct inflation protection. So you can start to see the characteristics really drive the fundamental performance of the asset class.
I mean, we hear that I think the term all weather used to describe infrastructure by institutions. What you described makes sense of why. Is that something that's new? Is that something that it's always been considered? We think why, if it is infrastructure getting more attention now?
Yeah. So it's definitely not new. The asset class has performed this way through cycles. And if you look at institutional investors like sovereign wealth funds and pension funds, they've historically had, I'm going to say necessarily meaningful, but they've certainly had allocations to infrastructure for quite a long time. And in some cases, those are meaningful allocations, like high single digits, even double digits, depending on where you go. So they've definitely seen how it can participate and how it can be a part of their portfolio. I think where infrastructure as an asset class has really started to pick up pace is now that these evergreen vehicles are available in the market, there's actually an access point for individual investors. Historically, they have not had that access point. So it wasn't really something that was front of mind for investors. So now you have the access point. There are ways to invest directly into private infrastructure. That's certainly raising the attention level on the asset class.
Yeah, it's interesting. Would you mind, like, so you can talk a little bit about, how cash flows, inflation, resilience, that sort of thing with these assets that you're buying. Would you describe sort of how you contract these assets, what the assets are, and just how they're different than the other assets that their clients are likely to own, like commercial real estate or, the other clients own other real assets. They own physical gold, real estate, but they don't own infrastructure. I mean, almost no individual clients own a real infrastructure asset.
It's very hard for them to own an infrastructure asset. So definitely not something in their personal portfolio or something they're directly owning. But when we think about how these contracts come to be and just kind of go through a couple sectors within infrastructure. So you think about power or water. So really utilities. Those are things, again, critical infrastructure, big physical assets, hard to replicate. Those are regulated assets. And so you have an agreement with a regulator around a rate of return, an equity rate of return that they guarantee you on the capital that you spend. And built into that equity rate of return is inflation protection. So now you have like a fixed series of payments over time. You have inflation protection, and really your counterparty is a government or a jurisdiction. So regulated assets are a big part of infrastructure as an asset class. The second one I might point to is in the digital space. It's very top of mind for folks, so I think it's important to talk about that. In areas like cell tower networks or data centers, we have big commercial customers. We don't have a government that sits on the other side. They're not regulated. But when you think about signing contracts in the case of data centers with hyperscaler customers for 10 or 15 years with fixed payments, sometimes even triple net lease fixed payments, you're really seeing like that consistent cash flow from a really high quality counterparty. And cell tower networks look very much the same. Long duration contracts, fixed payments. You're not taking risk on volumes going through the system either. And then maybe pivot a little bit over to another space in energy, whether it's renewables or natural gas pipelines are a big part of infrastructure as well. Those oftentimes have very long term contracts, 10 plus years, where you have a fixed payment stream for the ability to utilize the asset. So availability for power generation or just a portion of the capacity in a pipeline. And those are specific examples, but maybe just overarching across all of those are fixed payments, long duration, really high quality counterparts. And so as we go through cycles and see GDP move up and down and public equities move up and down, we don't have as infrastructure investors that same correlation to GDP moves. We move much slower up, we move much slower down. We're a much more stable asset class.
May I ask, just because, when you talk about they're inflation protected, can you explain specifically, like contractually, what that would mean?
Sure. So it varies by business, it varies by industry. In some businesses, like a regulated asset, it's actually the calculation for how you get paid from the regulator includes inflation. So you're investing capital, you have to continue to operate the assets. They will compensate us for the cost increasing to operate those assets. In other assets, this is common in the midstream space, big components of the OpEx are actually pass-throughs. And so, like, the fuel to run a natural gas pipeline oftentimes will just be passed through to the customers. And so, rather than inflation protect by moving up the top line, the revenue line, you just remove a big potentially inflationary component of the OpEx, and that's the calculation for how we get paid. In other industries, like in the digital space, for example, oftentimes there will be escalators in the contractual revenue line that says on an annual basis, we'll test against CPI, or we'll give an automatic 2% increase in the revenue line through time to compensate for inflation. So each industry and frankly, each contract can be a bit different, but fundamental because of the duration of these contracts, fundamentally, you need to have that protection because inflation can really change the economics of these assets if you're not consistently aware of it and consistently compensated for it.
Maybe let's take a minute and talk about, I think, the risks. I mean, one of the, I think the risks that a lot of clients will ask about is, data centers. Are there too many? Is there too much supply? For wind and solar, how much do subsidies affect these? Maybe talk a little bit about whether these are risks, and if they're not, what are the risks? What are the areas that you actually avoid because you feel like you can't really structure the risks in an appropriate way?
Sure. So maybe one thing that is, I would say, less of a risk in the infrastructure asset class, and then we'll talk about, I want to avoid the risk question. But what is less of a risk, I actually wrote a white paper January of last year, so a year old, but I think it's very timely in the market that we're in today. And it was titled Infrastructure's an Asset Class for All Economic Conditions. And what we did is we went back and we tested relative to other asset classes that an individual might be invested in, whether it's public equities or private alts. How did it perform in inflationary environments? How did it correlate to GDP? And importantly, how did it correlate to the other things already in an individual's portfolio? And what we showed in that paper, and it was not specific, it was industry wide. So we weren't trying to make a case of a specific vehicles. It was really about how does the asset class perform. But it really showed strong resiliency through market cycles. And in addition to strong resiliency through market cycles, the ability to continually, consistently generate returns through inflationary periods and through non-inflationary periods, or through volatility and through low volatility. So as the market moved in different ways, infrastructure was consistently generating returns. So I say all that because I think that removes a lot of the big macro questions that people have about the asset classes, or maybe doesn't remove it, but it certainly mitigates it. It turns down the volume on what are the typical risks for a lot of asset classes in portfolios. So then, what are the risks? While you can kind of turn down the volume on some of those big macro risks, we're investing in a lot of different asset classes within infrastructure, whether that's digital or renewables and energy transition or traditional energy. And each one of those is going to come with some, individual risks associated with each one. So, you mentioned, is it an overbuild in the data center space? That certainly could be a risk. Is it an overbuild in the renewable space? That certainly could be a risk, or overbuild in midstream. All those things exist. I think what we try and do as investors is look at the assets, and we have industry experts who are covering each one of these spaces and try and high grade the areas where we're looking in and make sure that they hit all of our key characteristics. So if you're developing a new data center, we need to make sure we have long-term visibility to cash flow, through cycle cash flows. We need to make sure that we have lots of visibility to that cash. We need contracts in place. We're not building assets on spec. If you build it, they will come. We're not doing that in our infrastructure practice. And frankly, a lot of the infrastructure asset class views it that way.
Interesting. So it's a very conservative asset class. I think it seems, relative to other things. There's a lot less speculation. you have an end user, you have contracted revenue, there's inflation hedges. So having said all that, what do you like in the space? What are the assets that are most interesting to you? And what stinks? What do you hate?
Sure.
You gotta hate something.
That's right. Sure. So, it's interesting. Sometimes we have these conversations. People call the asset class boring. I like to call it predictable. That's the word I'll use. Predictable. We're not boring. We're predictable. So, as we look at the asset class, a couple big areas, couple big themes that we're investing behind. These probably won't come as a surprise. One is digital infrastructure. The amount of capital that's being spent, the demand, and the willingness of really high quality counterparts to sign long-term take or pay contracts with inflation protection. This checks a lot of boxes. But in the case of data centers, as an example, not all assets are created equal, right? Like we want to be in tier one markets. We want to be in Dallas, Fort Worth, Northern Virginia, the Phoenix area, key core markets. And certainly we want to have really high credit quality counterparties because there is a risk that something could go wrong. So we want to make sure that we're with those hyperscalers or primarily with those hyperscalers in our business. So certainly that's a big theme, but we have to be conscious of the risk and we're not actively building data centers in Midland, Texas, where people are talking about building new data centers in not a primary market. We're not building them with really low quality credit quality counterparties because of the risk of not getting paid. So, in digital, we think about it that way. I would say on top of that, cell tower networks are also a big part of digital infrastructure. We've invested globally in the cell tower space, as well as fiber to the home businesses. Again, you just have to be really conscious of the structure of the investments you're making. Who are your counterparties? What's the duration of the contracts? That all is the same in digital. The second big area, and again, I don't think it's a surprise, will be in energy and energy transition. And we think they're both. There's plenty of room in the market globally. We're global investors. There's plenty of room in the market globally for both energy transition and traditional energy. On the energy transition side, that's renewable businesses, wind, solar, batteries. And in those businesses, they come with great contracts, low risk operations once they're in place, but you got to make sure you're not taking stroke of the pen risk. And so, like not paying for a really high growth potential, paying a high multiple for a business that has a lot of high growth potential, but doesn't necessarily have the assets yet. We really focus on buying existing assets in the ground and not really paying for the growth, but developing a team who can go out and create the growth on their own. So, what you pay for really matters in the renewable space. I think that goes for the traditional energy space as well. Buying assets in the ground and not paying a huge premium for potential growth on the other side of that. So very similar in energy and energy transition.
So, we were just talking about technological disruption earlier today and, the impact of that. How can, an infrastructure like something like driverless taxis, these kinds of things, like how does infrastructure benefit from these like secular changes that are just kind of just starting to happen?
Or conversely get hurt and you want
Yeah.
to stay away.
Yeah. I'd say one thing about infrastructure is because of the physical moat around these businesses, oftentimes they're the least disrupted of the assets. So like, we're obviously seeing a lot of movement in the software space right now where it's being disrupted. But at the same time, that means more data centers. You need the fiber connectivity, whether it's a SaaS business or Chat GPT that's solving the problem. You need the connectivity, you need the data center capacity to make it happen. So a lot of those big moves are we're oftentimes somewhat insulated from them because we're sort of the essential service provider sitting behind what's happening that's at the forefront, that people are talking about. So I do think there's a natural inflation, sorry, not inflation, there's a natural hedge against things like that in the market or in the infrastructure market.
And let's just say tech leads us into a deflationary market down the road. Do you still think infrastructure will generate decent returns if we have deflation in the future?
I think so. And we've certainly saw from, for quite a while, a no inflation market and infrastructure as an asset class performed well, where we had, up until 2022, rates were incredibly low. There were just no signs of inflation. Frankly, people were searching for yield because of the lack of rate increases, the lack of yield availability in the market. And there really was not a ton, if any, inflation through quite a long period of time. And the asset class performed quite well. I don't know that we've seen a deflationary market, and that would certainly be a test in the same way that 2022 and 2023 were a test of the inflationary components of the asset class. But again, I think the critical nature of what we're doing, the essentiality around the assets and the physical footprint in the ground gives us a nice buffer from what's going on more broadly in potentially a deflationary environment.
Yeah, James, to our clientele, one of the reasons why we're asking you to do the video is, we view this asset class as really interesting, and it's definitely not something that our clients have exposure to, where they have lots of exposure to private equity and venture and public equities. We think this is an asset class they're underexposed to, and we're sort of intrigued by the diversification benefits of it, and solid returns.
Yeah, and we're trying to look for things that, in fact, maybe can do well when the rest of the client's portfolio is not doing so well, because most things, in fact, are quite correlated.
Yeah. Well, I mean, James, your comments have been really good. Is there anything you would like to leave our audience with?
The other thing, building on what you were just saying, when people think about adding infrastructure to their portfolio, we think it is a great diversifier, a great complement to what's in the portfolio today. Provides a little bit of a different return profile, as well as upside potential and capital preservation. And then when you look at it relative to other asset classes that are definitely already in their portfolios, that low correlation, or at least moderate correlation, means that it really does act as a diversifier. So it's something that we spent a lot of time speaking with folks about as we've developed our evergreen private infrastructure strategy.
Well, James, thanks for joining us
Thank you
today
very much.
and talking about this. To all our clients, you know that we think infrastructure is really an interesting space, and we think the evergreen structure makes really the most sense for individual investors. So thanks for spending time with us. We're happy to answer any questions. Please follow us at Aligned Wealth, and please call with any questions.
Thank you. Thank you, James.
Thank you guys. Appreciate it.